Imagine this, you check your investment account on Monday morning and you're up $5,000. Nice, right? You feel pretty good, not ecstatic, just good. Maybe you smile, nod to yourself, go about your day. Now imagine it's Friday, you check that same account, you're down $5,000. How do you feel now? If you're honest with yourself, you feel terrible, like someone punched you in the stomach. You can't stop thinking about it. You check your phone compulsively. You lie awake at night running through scenarios. That $5,000 loss consumes you in a way the $5,000 gain never did. Same amount of money, completely different emotional response. And here's the really messed up part. This psychological quirk is quietly destroying your financial future, and you probably don't even realize it's happening. My name is Elon Musk, and I spend way too much time thinking about why smart people make dumb financial decisions. If you're someone who's ever sold an investment at a loss because you couldn't stand watching it drop anymore, or if you've ever held onto cash because investing just feels too risky right now, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because today we're diving into one of the most powerful forces in behavioral finance, something that Nobel Prize winners have studied, something that separates wealthy people from everyone else, and something that's probably cost you more money than you realize. Here's the thing, your brain is lying to you about money. Not in some abstract philosophical way. I mean, it's literally miscalculating the value of your financial wins and losses, and the math behind this miscalculation, it's staggering. There's this concept in behavioral economics called loss aversion, and when researchers at Princeton actually measured it, here's what they found. The average person feels losses approximately 2.5 times more intensely than equivalent gains. Let me say that again because it's important. A $1,000 loss doesn't just feel bad. It feels as bad as a $2,500 gain feels good. Your brain is literally weighing losses at 250% of what it weighs gains. Now you might be thinking, okay, so what? I'm just more careful with my money. That's probably a good thing, right? Wrong, dead wrong. And I'm going to show you exactly why this psychological quirk is one of the biggest obstacles standing between you and actual wealth. Look, let me paint you a picture that really drives this home. A few years back, researchers at the University of California ran this fascinating experiment. They put people in a simulated trading environment, basically like a video game where you're buying and selling stocks. Simple setup, no real money at risk. They split people into two groups. Group A got to see their portfolio performance updated in real time, every single change up and down all day long. Group B only saw their results at the end of the day. After several months, guess which group made more money? Group B crushed it, and I mean crushed it. They outperformed Group A by an average of 35%. Same market conditions, same stocks available, same everything. The only difference, how often they saw the losses. Because here's what most people don't realize. When you're checking your portfolio constantly, you're not getting more information that helps you make better decisions. You're just exposing yourself to more perceived losses. And every time you see red numbers, your brain screams at you to do something. Usually that something is exactly the wrong thing. The Group A participants sold winners too early because they were afraid of losing their gains. They held losers too long because selling meant locking in the loss and making it real. They traded more frequently, racked up more fees, and made more emotional decisions. All because they were looking too often. Now let's talk about what this actually costs you in real dollars. Because this isn't just some interesting psychology experiment, this is your retirement we're talking about. Let's say you're 30 years old and you start investing $500 a month. Over 35 years until you're 65, assuming a pretty standard 8% annual return, you'd end up with about $1.1 million. Nice, solid retirement fund. But here's where loss aversion comes in. Studies by a financial research firm consistently show that the average investor underperforms the market by about 4% annually. Not because they're picking bad investments, but because of behavior. Specifically, they sell when things drop because losses feel unbearable, and they buy when things are high because gains feel safe. So what happens if instead of getting that 8% return, your emotional decisions mean you only get 4% because you're constantly selling low and buying high? You end up with $430,000. You just lost $670,000 to your feelings. Let me be clear, that's not $670,000 in one dramatic mistake. That's death by 1,000 cuts. Every time you checked your portfolio during a downturn and felt that sick feeling. Every time you convinced yourself, I'll just wait until it recovers before investing more. Every time you sold because you couldn't take the pain anymore. All those tiny emotional decisions, compounded over 35 years, cost you more than half your retirement. This is where it gets really interesting. Your brain doesn't just feel losses more intensely. It also uses completely irrational mental accounting to deal with them. Let me give you a concrete example. Let's say you bought shares of a tech company at $100 per share. You bought 50 shares, so you're in for $5,000. 6 months later, that stock is at $80. You're down $1,000. How do you feel about this investment? Most people would say it's a bad investment or they're losing money. But here's the thing, you haven't lost anything yet. It's just a number on a screen. The only way you actually lose money is if you sell at $80. Now let's say at that same moment there's another stock, a competitor in the same industry, trading at $80. All your research says this competitor is actually better positioned for the future. Better management, better technology, better growth prospects. The rational move, sell your stock at $80 and buy the competitor at $80. You're making a simple swap to a better investment. But you won't do it. You know why you won't do it? Because selling at $80 means locking in that $1,000 loss. Your brain categorizes that as realizing the loss, making it real and final. Meanwhile, as long as you hold the original stock, you can tell yourself it's just a paper loss and it might come back. So you hold on to an inferior investment, waiting for it to get back to $100 just so you can break even, while you watch the better opportunity from the sidelines. This is insane. This is completely irrational. The $1,000 is already gone from an economic standpoint. Whether you sell or hold doesn't change the fact that your portfolio is worth $1,000 less than it was. But your brain is using mental accounting tricks to avoid the emotional pain of making the loss official. There's actually a name for this phenomenon, the disposition effect. A study published in the Journal of Finance analyzed over 10,000 brokerage accounts and found that investors were 50% more likely to sell investments that had gained value compared to investments that had lost value. Think about that for a second. People are selling their winners and holding their losers. It's literally the opposite of buy low, sell high. They're doing sell low, buy high because of how losses make them feel. And here's the kicker. This study found that the stocks investors sold, the winners, went on to outperform the market by an average of 3.4% over the next year. Meanwhile, the stocks they held onto, the losers, underperformed the market by 1.1%. So not only are you making emotionally driven decisions, but those decisions are consistently wrong. You're selling the things you should keep and keeping the things you should sell, all because you're trying to avoid the emotional pain of realizing a loss. Now you might be thinking, okay, I get it, losses feel worse, but I can just ignore that feeling, right? I can be rational about this. Look, I wish it were that simple. But there's another layer to this that makes it even more insidious. Your brain doesn't evaluate gains and losses in absolute terms. It evaluates them relative to a reference point, usually what you paid for something or what you think it should be worth. Here's a perfect example. Let's say you bought a house in 2021 for $400,000. By 2022, comparable houses in your neighborhood were selling for $450,000. You felt pretty good, right? You were up $50,000. Then 2023 hits, interest rates go crazy, and now comparable houses are selling for $420,000. How do you feel? If you're like most people, you feel like you lost $30,000. Even though you're still up $20,000 from what you paid, your brain shifted its reference point to that $450,000 peak. So now you're measuring everything against that high water mark. This is why so many people held onto houses too long after 2008. They couldn't accept selling for less than what it's worth, where what it's worth meant what it was worth at the peak. They'd rather hold an empty house and make payments than sell it at a loss relative to that peak value. Never mind that the market had fundamentally changed. Never mind that every month they held it, they were losing more money in payments and opportunity cost. Their brain had set a reference point, and selling below it felt like losing. And this brings me to what might be the most expensive part of loss aversion: opportunity cost blindness. When you're so focused on avoiding losses, you become completely blind to the opportunities you're missing. Let me give you some real numbers on this. During the COVID crash in March 2020, the S&P 500 dropped about 34% in just over a month. It was brutal. If you had $100,000 invested, you watched it drop to $66,000. That loss, it felt enormous, visceral, real. A lot of people sold. They couldn't take the pain. They pulled their money out and went to cash, telling themselves they'd get back in when things stabilize. But here's what happened next. By August 2020, just 5 months later, the market had fully recovered. By the end of 2020, the S&P 500 was up 16% for the year. By the end of 2021, up over 26%. If you sold in March 2020 and your money sat in cash earning basically nothing, you missed one of the fastest recoveries in market history. That $66,000 could have been $126,000 by the end of 2021. But instead you have $66,000 in cash, safe. Except it's not safe at all because inflation during that period was eating away at your purchasing power. So that $66,000 in 2021 could buy you less than $66,000 in 2020. You were so busy avoiding the pain of watching your portfolio drop that you missed a 91% return in less than 2 years. The loss you avoided by selling, it was temporary. The opportunity you missed by being in cash, that's permanent. Here's what's really messed up about all this. The asymmetry goes both ways, and both directions cost you money. On one hand, losses feel worse than equivalent gains feel good, which makes you overly conservative. You avoid risks that are actually mathematically in your favor because the potential loss looms larger in your mind than the potential gain. But on the other hand, when you do have gains, they don't feel as good as they should, which means you don't learn the right lessons. Let me explain. You make an investment, it goes up 25% in 6 months. You feel pretty good, maybe a little smug, but that feeling fades fast. Within a few weeks, that gain becomes your new normal. Your reference point shifts up, and now you're measuring future performance against this higher baseline. Then inevitably there's a correction. Your investment drops 10%. Even though you're still up 12.5% overall, you feel terrible. Because you're not comparing it to what you initially paid, you're comparing it to that peak. Your brain categorizes this as a loss of 10%, even though it's really a gain of 12.5%. So you never get the full emotional reward for being right, but you always get the full emotional punishment for any drawdown. This creates this exhausting hamster wheel where gains never feel quite good enough, but losses always feel catastrophic. Now let's talk about something that makes this even worse, the denominator problem. When you see that your investment dropped 10%, your brain processes that as a big, scary number. But here's what most people don't realize. Percentages are relative, and your brain is really bad at intuiting what they actually mean in different contexts. Let's say you have a portfolio worth $500,000 and it drops 10%. You lost $50,000. That's a lot of money. It feels huge. You lie awake at night thinking about what you could do with $50,000. But now let's say your portfolio is worth $50,000 and it drops 10%. You lost $5,000. Same percentage, but does it feel the same? Of course not. $5,000 feels like a setback. $50,000 feels like a catastrophe. Here's the thing though, from an investment perspective, the percentage is what matters, not the absolute number. A 10% loss is a 10% loss. The fact that it represents more dollars when your portfolio is bigger doesn't actually change anything about the investment's prospects or your strategy. But your emotions don't scale linearly with percentages. They scale with absolute dollars. So as your portfolio grows, the emotional impact of equivalent percentage moves gets bigger and bigger. This is why you see wealthy people making increasingly conservative decisions as they get richer. Not because it's mathematically optimal, but because the absolute dollar amounts of potential losses start feeling unbearable, even when the percentages are the same as always. Someone with $10 million might avoid an investment opportunity that has a 70% chance of returning 15% and a 30% chance of losing 10%, because that 10% loss would be $1 million. The fact that the expected value is strongly positive doesn't matter to their emotions. The possibility of losing $1 million feels too painful to bear. So what do we do about all this? Because look, I can tell you all day that your emotional responses to money are irrational, but that doesn't make the emotions go away. You're still going to feel sick when you see red numbers. You're still going to feel relieved when you lock in gains. This is where we need to shift our framework from trying to eliminate emotions to building systems that work with your psychological quirks instead of against them. Jeff has this concept he calls the regret minimization framework. The idea is simple. When making a big decision, project yourself forward to age 80 and ask what you'll regret more, trying and failing or never trying at all. We can apply a version of this to investing. When you feel the urge to sell during a downturn, ask yourself, if the market recovers from here, will I regret selling? And if it doesn't recover for years, will I regret holding? For most people, if you're honest with yourself, the regret from missing a recovery is worse than the regret from holding through continued declines. Because continued declines are temporary, but missed gains are permanent. But here's the key, you have to make this decision before the downturn happens. You can't wait until you're in the middle of a 30% drop and your heart is pounding and you're checking your phone every 5 minutes. By then, your emotional brain has taken over. So here's what I want you to do right now today. First, automate everything you can. Set up automatic contributions to your investment accounts. Don't give yourself the opportunity to wait for a better time because your emotions will always find a reason to wait. Dollar cost averaging isn't just a good investment strategy, it's a psychological hack that removes emotional decision-making from the equation. Second, limit how often you check your accounts. Remember that experiment I told you about earlier? The people who checked less frequently made 35% more money. Set a schedule once a month, once a quarter, and stick to it. Put reminders on your calendar if you have to. Checking your portfolio when nothing has changed in your investment thesis does nothing except expose you to emotional volatility. Third, write down your investment thesis for every position you hold. Not vague stuff like "I think tech is the future." I mean specific, concrete reasons why you believe this investment will perform well over your time horizon. What would have to change fundamentally for this thesis to be wrong? Then, when you feel the urge to sell during a downturn, you can look at your thesis and ask, has anything fundamentally changed, or am I just reacting to price movements? If nothing fundamental has changed, you know you're making an emotional decision, not a rational one. Fourth, implement a 24-hour rule. If you want to make a significant change to your portfolio, selling something at a loss, moving to cash, whatever, write down your reasoning and then wait 24 hours before executing. You'd be amazed how many bad decisions you'll avoid just by introducing this cooling-off period. Your emotional brain thrives on immediacy. It wants you to act now to stop the pain now. But investment decisions should almost never be made in the heat of the moment. Fifth, reframe losses in terms of time, not money. Instead of thinking, "I lost $10,000, think, "My portfolio is back to where it was 6 months ago." This might sound like a small semantic difference, but it's huge psychologically. Losing $10,000 feels like something valuable disappeared. Being back to where you were 6 months ago feels like you just need to wait a little longer. Same situation, completely different emotional response. Here's what it ultimately comes down to. Building wealth requires you to think in probabilities and expected values, but your brain is wired to think in absolutes and worst-case scenarios. Your ancestors who worried obsessively about losing their food stores survived famines better than the optimistic ones who assumed everything would work out. So loss aversion served us well for most of human history. But in modern investing, it's actively hurting you. The stock market has averaged about 10% annual returns for the past century. That includes the Great Depression, World War II, the dot-com crash, the 2008 financial crisis, COVID, all of it. But to capture those returns, you have to stay invested through the inevitable downturns. And that means accepting that sometimes, maybe even frequently, you're going to see red numbers on your screen. You're going to feel that sick feeling in your stomach. You're going to wake up and wonder if you should do something. The difference between people who build lasting wealth and people who don't usually comes down to this. Wealthy people have learned to sit with that discomfort, to acknowledge it, to feel it, and to do nothing. Because most of the time in investing, doing nothing is exactly the right move. Look, I'm not going to pretend this is easy. If it were easy, everyone would be wealthy. But understanding why financial wins feel smaller than losses, understanding that it's a quirk of human psychology that evolved for different purposes, gives you the tools to work around it. You can't eliminate loss aversion, but you can build systems that minimize how often you trigger it. You can make decisions in advance when you're calm and rational about how you'll handle inevitable downturns. You can automate your investment process so your emotional brain doesn't get a vote. And most importantly, you can remind yourself that the temporary pain of watching your portfolio drop is nothing compared to the permanent cost of sitting on the sidelines while opportunity passes you by. Every day you let loss aversion drive your decisions is a day you're leaving money on the table, not hypothetical money. Real money that could fund your retirement, pay for your kids' education, give you the freedom to quit a job you hate. So the question isn't whether losses feel bigger than gains. They do, they always will. The question is, are you going to let that feeling cost you your financial future? Because here's the truth that nobody wants to hear. The market doesn't care about your feelings. It's going to go up and down regardless of whether you're comfortable with it. The only question is whether you'll be invested to capture the gains or sitting in cash trying to avoid the losses. Your move. If this video helped you understand the psychology behind your financial decisions, smash that like button and subscribe for more content on building lasting wealth. Drop a comment below and let me know, what's the biggest financial mistake you've made because of loss aversion? Let's learn from each other. Until next time, make smart decisions, not emotional ones.